if we're basing this purely on math, right, the stock market usually goes up, as you said, Duncan. All else equal, you want to buy fast and sell slow. That means lump sum, put it in quickly, get it invested. The stock market usually goes up. But when you're selling, you want to string it out. So that could mean end of the year, or it could mean dollar cost averaging out instead of beginning of the year. So that's math if you're playing the probabilities, spreadsheets, market history, that sort of stuff. However, some people cannot stomach the math, for psychological reasons. So some people prefer to dollar cost average into the market, even when sitting on a lump sum and knowing that's the better option. Some people also want to hedge against bad luck and say, if I take it all out every year in December or every year in January, what if that's just a bad time and the stock market had just fallen? And so I want averaging out is a hedge against bad timing or bad luck. I think that's totally reasonable. I think you could make the case about when to sell in a number of different ways. I think if you pull it all at the end of the year or the beginning of the year or the middle of the year, like, you could get that bad luck and timing. So most of the time it won't happen, but sometimes it will, and you're going to be second guessing yourself or kicking yourself. So if you're really worried about that scenario, maybe once a month or once a quarter makes sense. I do like the idea of selling out at the end of the year, just because it allows for more growth potential, and you'll have that cash ready for spending purposes heading into the next year. Whatever you do decide to do, I would pick a strategy that you can stick with and not try to tinker with it. If you keep changing the intervals based on what you wish would have just happened, that's the problem. So I think you just figure out whatever you're good with and stick with it.